Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hi, this is ETF Market Insights, and I'm your host, Erin Allen with BMO ETFs. Thanks for watching today's session. Today we're going to be looking at currency, how it can impact your portfolios, and the different ways that you can manage currency exposure using ETFs. Before we get started, just as a reminder, we're not providing you any advice or investment recommendations today. Today's episode, like all of our episodes, is all about education around investing and around ETFs for investors who are really looking to take charge of their own portfolios. I have a bonus disclaimer today because we have our partners from InvestorLine here. So again, our colleagues from InvestorLine not providing any advice or investment recommendations. Their portion of the presentation is for informational purposes only as well. With me today, thank you all for joining me. I have my colleague Om from the Portfolio Management Desk here at BMO ETFs. I also have Andrew Vachon, my old colleague from the product team. He's our, I didn't mean to stress old there, but he's a senior product manager on the BMO ETFs team here. And I'm also joined by Ravneet from InvestorLine, who's going to take us through sort of the latest from IVL and some promotional offers as well on today's episode. Before we get started, a reminder to check out our YouTube channel, subscribe so you can watch any episodes as they go live, and you can check out episodes that you may have missed there as well. I also just wanted to give a shout out and a reminder that we have a 2-week special edition of ETF Market Insights coming up on October 21st and 28th. This is our fall into ETF events, so please tune into that. You can check out the trailer on our YouTube channel for that as well. Okay, so today we're going to talk a lot about currency. Oftentimes when we consider an investment, we don't really think about currency. We're thinking about the future outlook for that particular company or sector or even geography. But there is a risk in terms of how the Canadian dollar can move versus US, international currencies, and that can play a big role in your overall total return. So we're going to get into that impact of currency and how you can hedge that risk in your portfolio if you wish to do so, and how ETFs are a great tool for that. So to get us started, Andrew, can you walk us through an introduction into what we mean by hedging the currency exposure in your portfolio and what the difference is between a hedged and an unhedged ETF?
Yes, thank you, Erin. Happy to be on Market Insights again. Really, currency hedging is removing the effects of foreign exchange movements, giving you a return that approximates the return of the local market. So as Canadian investors, we don't always invest 100% of our portfolio in Canadian securities. We look to other countries to invest in as well, such as US, China, or Europe. Now, these securities trade on their home exchanges with their local currencies. And so for Canadian investors, there's going to be foreign currency exposure tied to these foreign assets. And currency, for whatever reason, tends to be a secondary consideration for people when they invest in foreign assets. For instance, when you buy stocks such as Microsoft or Apple, you may have a view on where that particular company is going to go, but you don't necessarily have a view on what the impact is, USD relative to CAD, for instance. So this is essentially where currency hedging can come into play. Now, with regards to hedging, if you're an investor who chooses to hedge to CAD, you're essentially eliminating any foreign currency exposure. Their return will be focused more on the performance of the foreign securities. And if you choose to keep that exposure, the foreign currency, they'll go unhedged if you want to keep your exposure to the foreign currency, which there are some benefits of being unhedged as well, since currency exposure can potentially improve returns and add to diversification. So being unhedged, the investor will get the return of the security along with the return of the underlying currency versus the Canadian dollar. The beauty of ETFs is that you can access the global investment universe on the TSX at the tip of your fingers to get those foreign exposures, and often even choose their currency exposure. Erin?
Yeah, that's great. And I know you mentioned that it can have a huge impact on your return one way or another. So build off that. What's the impact on the total return of an investment potentially when it comes to currency?
Sure. So when you're thinking about investing, it makes sense to invest outside of Canada since it does add diversification. And when you do invest outside of Canada, there's two sources of return, as I mentioned. One being the return of that particular security, and two, the return of that currency associated with that security. And currency does tend to fluctuate. For example, looking at the graph here and paying attention to recent COVID crisis, the unhedged S&P 500 has exposure to the S&P 500 returns along with the currency return. And the hedged ZUE S&P 500 would take out the impact of the currency return and just provide the returns of the S&P 500. Having an understanding of the correlation between these investments and its currencies may also impact the decision to hedge or unhedge. So what I mean by this is some currencies, such as the US dollar, tend to be negatively correlated to equity markets. And typically what happens during an equity crisis, the USD gains in value as investors tend to flock to safety. An unhedged position can potentially reduce the volatility of the investor's portfolio. For example, back in March of 2020, the unhedged ZSP, by having USD exposure, actually did much better because it rallied, the US dollar rallied. This feels all very recent, but if we fast forward to today with inflation running hot, interest rates rising, and the war in Ukraine, we are seeing something similar happening. Erin?
Perfect. That's a great intro into hedged and unhedged exposures. In addition to those hedged and unhedged ETFs for flexibility in terms of currency exposure, we also have US dollar denominated exposures. We call them .Us because the end of the ticker is always .U. So ZSP.U would be our S&P 500 US dollar denominated exposure. A lot of investors are quick to sort of jump to that US listed exposure when they have US dollar funds. But can you explain why our .Us or Canadian listed USD exposures are great for investors?
For sure. Thanks for having me here, Erin. So for the .U ETFs, I just want to clarify they are USD denominated ETFs. So they're not currency hedged, or there's no conversion of Canadian dollars to US dollars. So investors, as Canadians, a lot of Canadians have a lot of US dollars, as a lot of them tend to travel to the US for whatever reason, vacation, maybe they have a vacation house there, maybe they have kids going to school there. So they tend to have a lot of US dollars. So by investing in .U ETFs, any income or dividends that you do receive, they are in US dollars. Let's say you sell that investment after 1 year, 2 years, 3 years, whatever the time frame, the cash that you receive back is in US dollars. So there's no conversion happening. And one of the best benefits of this is that, investors can avoid that conversion fees. That conversion fees can be anywhere from 0.3% to as high as 2.5%. And, applying that conversion fees every time you want to convert Canadian dollars to US dollars or vice versa can get pricey. So that's one of the greatest benefits, having these .U ETFs, is where you can invest your US dollars and be able to, get that capital gain, but at the same time get income. Another benefit is, we know during winter times Canadians like to, travel to kind of Florida for the warm weather. They have vacation properties there, so they do have expenses in US dollars. So by investing in the .U ETFs, they are able to match their cash flows that they receive from the ETF versus their expenses without worrying about any conversion fees. And finally, another great benefit is on the tax side. So, there's no estate tax for .U ETFs. And that's because these are Canadian listed ETFs. They're not listed, even though they're US denominated. So it could be US denominated equity ETF or bond ETF, but they are listed on the TSX. So there's no US estate tax. And also there's no tax form required for the, the T1135 tax form, that foreign income that you have to fill out. And since you don't have to fill it out during tax season, it makes it much more simpler. That's one less form, clients or investors have to worry about during tax season. So a lot of great benefits for investors looking for that USD investment in the Canadian market space.
That's perfect. Thanks, So yeah, for snowbirds or for people who are affected by a U.S. estate tax and the burden of that T1135, these are great options for investors, and a good thing to consider there. Okay, Andrew, let's summarize sort of what the different currency options available to Canadian investors in terms of ETFs are before we get into some of the other considerations.
Yeah, one of the many benefits of ETFs is that you can manage your currency exposure. It's becoming more and more popular today. Many ETF providers offer 2 or 3 currency options on the same strategy. So investors can choose the type of exposure they want. Essentially, investors typically go about it 2 to 3 ways when investing. If they want to make a currency call, they usually go unhedged to take advantage of potentially 2 sources of return, or they want to go, or maybe they'll want to access a particular index and not have to worry about the currency fluctuations. They'll go hedged. And finally, if an investor just holds, say, US dollars, they can purchase the US dollar ETFs that trade in Canada. BMO's S&P 500 ETF, as an example here, which is the largest US equity ETF in Canada. If an investor wants to get exposure to the S&P 500 unhedged, then ZSP is the way to go. If they don't want the exposure to the USD, then you'd want to look at ZUE. Or if they just want to put some US dollars to work, then ZSP.U would be the solution. And the beauty of it is that there's no additional charge to the cost, no change to the cost, that is. It's the same price across all 3 tickers, which is great. And this goes for all other companies as well across the board, I believe. Erin?
Yeah, I think that cost point is really important because, if an investor was going to go out and try to hedge their own portfolio, they would not only need the expertise of trading options in order to hedge those currencies, but there's a huge cost to it as well in terms of the premiums that they would need to pay and on the options and of course the expertise. So ETFs are just such a great access tool to give investors the flexibility to control that currency risk in their portfolio. So great invention for sure. Back to you. Let's look at the different factors that impact currency and what should investors be looking at when they're thinking about making a call around currencies.
For sure. So in terms of different factors, there's a lot of factors that go into kind of valuing a currency. So one of the most important factors is interest rates. And so the interest rate, when I say interest rates, it's kind of tightly tied to 2 other things. It's inflation and also kind of exchange rates. So different countries and their central banks have different policies around how they want to monitor their interest rate to help control or modulate inflation within their country. So to give you an example, if you look at just in Canada, we have seen inflation skyrocket from kind of March onwards, hitting all-time highs that we haven't seen in decades. And to fight that inflation, we've seen Bank of Canada increase interest rates at a much faster pace compared to some of the other countries, such as in Europe or in or Europe or Nordic countries. So we saw that when the Canadian Bank or Bank of Canada was increasing rates, the Canadian dollar was actually rallying versus these European currencies. So that's one of the most kind of important factors that impacts it. Another one is, if you look at stimulus or budgets, different governments have. So, if you rewind back to like 2020, when, we were peak COVID, we saw a lot of fiscal stimulus by governments. So what happened was they were borrowing a lot of money to help fund a lot of different programs. And by borrowing, taking this large scale deficit, what they're hoping for was, they're borrowing to finance economic growth. However, if the debt that they borrowed outpaces the economic growth, the currency gets devalued as it drives up inflation. However, we saw in 2020 that, as Canadian government or even US or world governments borrowed money to finance the economic growth, it was going well until, end of 2021 when inflation started to set in. Third, and this is more, I would say, Canadian factor is, energy prices. So oil or natural gas or even commodities, like timber prices impact the Canadian dollar value. So, we are also known as the commodity currency. So we have, oil, natural gas, even timber. So as we are exporting these commodities or energy prices outside, the higher the prices, the more beneficial it is for the Canadian dollar. And we saw that, we've seen that correlation between oil and Canadian dollar back in like 2009. This year also we saw that correlation. However, it wasn't as strong because there are a lot of other factors impacting that correlation. And over the next few slides, I'll cover that impact as well. And finally, is just the demand for the Canadian dollar, US dollar. So as the demand increases, the value of that currency increases. So we've seen that recently in on the US dollar, where the demand for US dollar increased substantially in the month of September. And we saw the US dollar have a very strong performance during that month. So as the demand for something increases, the price tends to increase. So those are the kind of the main four factors, that impact any currency. Of course, we can get into the nuances about, what impacts which currency, which factor impacts which currency more. But, these are kind of four major factors that impact majority of the currencies.
Sounds good. Thanks, Om. And Andrew, let's go through some numbers here, because I think these are great charts to showcase the impact. What are some considerations that investors should look at when they're looking at whether to hedge or not hedge?
Absolutely. Well, first and foremost, we may want to ask ourselves, how much will currency impact your portfolio over time? And in this chart, year by year, it shows the return of the S&P 500 using the hedged exposure versus the non-hedged exposure. The returns on average are actually relatively the same, and this is dating back 17 years, as you can see, 11.47 versus 11.87. However, the standard deviation or volatility in the unhedged portfolio is actually lower, a 300 basis point difference approximately. So you're getting the same performance with lower risk. And take a look at 2008, if you can see, we saw the hedge down almost 40%. The USD gained significantly during this time. So an investor with an unhedged exposure would improve their position by about 18%. And this chart, as much as it shows over the long-term performance being very similar, it does show the short-term impacts as well. So it's important to be aware of your currency options. One of the things that you can control, as I mentioned, with your investments is how diversified you are, and by having some portion of your portfolio unhedged, one could add to that diversification, and one could also generate alpha in the portfolio by hedging or not hedging. When we get to the high end range or the low end range of the particular currency you're looking at, as a tactical play, we could either choose to hedge or not to take advantage of a potential rally. But beyond that, it's just a great idea for investors to have that currency diversification in their portfolio.
Yeah, I think that the time horizon consideration is a big one. This chart just shows it so well over the long term. That's got that purchasing power parity. It's all going to come out about equal. But over the short term, looking at some of those fluctuations in certain years, it can really impact your bottom line. So thank you for that. Let's move into look at current valuations and CAD versus USD. How's it looking year to date?
Yeah, perfect. So you can see in the chart, if you look at from January till end of August, it was in a pretty tight range. You would say on average around, it was bouncing around from 1.25 to 1.3. However, during this period, we saw both the federal bank in the US and Bank of Canada, increasing rates at a much faster pace to tackle inflation. And we saw Bank of Canada at the beginning was hiking rates at a much faster pace compared to even the federal bank in the US. At the same time, we saw in Europe, the Russia-Ukraine war started, which forced, supply crunch in oil prices. So we saw oil prices rally significantly, hitting, $100 per barrel. And being a commodity currency, it actually supported the Canadian dollar. So up to the point of August, we saw the supply and demand of both Canadian and US dollars being around 1.25 to 1.3. However, September, the story changed. We did see US dollar rally significantly in the month of September. Usually, one of the reasons is during the month of September, we saw the Russia-Ukraine war it went to the next phase, which was annexation. So we saw a significant risk of recession in Europe because of this. Secondly, we saw inflation within US hitting all-time high. So we saw Feds come out saying we'll do everything in our power to bring it down. So, investors wanted to have that flock to safety. As Andrew mentioned previously, US dollar is known as a safe currency, a safe haven. And usually what happens during this period is a lot of investors, they want to go buy the US Treasury. And to be able to buy the US Treasury, they need to convert their currency into US dollars and then go buy the Treasury. So we saw in the month of September a lot of that, buying in the US Treasury, going into safe haven currencies. And that's why we saw that sharp rally in the month of September, even though for the first 8 months it was pretty much in a tight range. Moving forward, we are cognizant of the risks and in the world with Russia, Ukraine, with inflation, with China, with their zero COVID policy. So there are a lot of kind of headwinds in the market. So we could see this, flight to safety in US dollar around for some time.
Perfect, thanks, Elm. And then what about CAD versus some of the international currencies? What are some considerations investors should take, specific to international currencies?
Yeah, for sure. So, if you look at the chart or the table, you can see the year-to-date performance of the Canadian dollar versus different foreign currencies. So if it's green, that means, if it's on the right, so you can see versus the US dollar, we actually underperformed. So that means the Canadian dollar depreciated versus the US dollar by, I think it's about 8% approximately. Versus the Swiss franc, it's basically flat. So the year-to-date performance, there's no change or very small change. But the most important thing I want to focus is on all the red. So that shows that the Canadian dollar actually appreciated against all these European Nordic currencies, even though the world is focusing on just the US dollar. So we did see a lot of strength in the Canadian dollar during year-to-date. And that's mainly because of the very hawkish Bank of Canada, strong commodity prices, not just oil and natural gas, but also timber. I know in terms of considerations, in Europe, it's a very risky space currently. There's less diversification and higher geopolitical risks. So to give you an example, just focusing on Russia and Ukraine, we can see that, during the period, a lot of their economy, their GDP growth has come to a halt because of the energy crisis. And because of that, we've seen the euro depreciate to all-time lows that we haven't seen in a very long time. Versus the US dollar, it's at parity. We saw tensions within UK because of this, where they're coming up with new fiscal policies, which is impacting the GBP or the British pound. So one of the consideration in terms of hedging is, diversification benefit. So as Andrew mentioned, having US dollar actually helps, provide that diversification benefit, lower volatility in an overall portfolio. But in the EFI space, it actually does not provide that diversification. If anything, it increases the risk of the overall portfolio. So we usually recommend having a hedged exposure there, as to not have your portfolio have a negative impact based on currency. In the EM space, so emerging markets such as like Brazil, China, Turkey, there's a lot of cost to hedging because their interest rates are so much higher. So there's a cost and friction to hedging. So within the emerging market space, the investors need to have a balance between the cost of hedging versus their view on the emerging market currency, in the sense that, if you are in an era of, 2020 or 2022 where markets are coming off significantly, these emerging market currencies tend to depreciate at a much faster pace compared to developed currencies. So having a hedged portion during times of tough times makes sense. But overall, I would say, in the EFI space, of course, hedging overall exposure in the euro, GBP, or any of the Nordic currencies in this time makes sense.
Awesome, thank you. And yeah, of course, it depends on your own views and your time horizon there as well. But that's some good ideas there. Now, quickly walk us through this chart. It's from Capital Markets. It's our forecast at BMO in terms of currencies for the rest of the year.
For sure. So you can see in the short term, the currency market can be very volatile. So if you look at just the first line where it's Canadian dollar per US dollar, you'll see the actual in September is about 1.33. October forecast, 1.36, and we can see as high as going to, 1.4. And realistically, this is just a forecast, and we can see this, the 1.4 come as soon as next week, as soon as today, and that's because on the US dollar, there's still a lot of stress in the market. So there's a lot of demand for US dollar. We've seen Feds be much more hawkish now compared to Bank of Canada. So the interest rate differential will increase there. So in the short term, there's a lot more volatility in the currency. However, in the medium to long term, as we saw in the table that Andrew had presented a few slides back, over the medium to long term, it kind of averages out the currency return, because it goes back to close to that 1.25 to 1.3 USD CAD rate. However, as this recession fear starts to, I would say subside, as we see inflation start to come down, we should see a boost on the Canadian dollar. And you can see that, at the end of kind of Q4 of next year, you can see the prediction of USD CAD to be around 1.3, which is kind of the long-term average around 1.25 to 1.3. On the European side, you can see even in the long term that there's a lot of structural issues in that region. There's the war, there's just EU debt within the union. So you can see there's a lot of structural issues there. So that's why, even in 2023, you can see the currency forecast. It doesn't appreciate as much as the Canadian dollar does. And if you look at kind of the euro, it appreciates very slightly from 0.99 to 1.01. So I would say, again, having, based on your portfolio, of course, and long term, your time horizon, hedging the European currencies makes sense. On the Canadian side, again, depending on your time horizon, if it's medium to long term, having hedging around 1.4 or anything higher on USD CAD tends to be a better diversifier at those levels.
Perfect. Thanks, Thanks for your insights there. Andrew, to close out our chat around currency, let's walk through what's available to investors and how they can sort of identify the different currency options out there in terms of ETFs.
Of course, if you're looking to buy an ETF in Canada that holds foreign securities, there's a few ways you could do that, as we mentioned. First, you want to identify whether they are hedged or unhedged. So generally, hedged ETFs will actually say hedged in the name. For example, iShares S&P 500 ETF says hedged to CAD or CAD hedged. Same with Vanguard's and BMO's as well. There's also ETF ticker extensions, as we mentioned, such as .Fs, .Bs, or .Us. .fs indicate hedged to CAD. .b unhedged. .u is traded in US dollars for those wanting to put USD to work. I will mention that .us are more popular among Canadian ETF providers like BMO. US-based providers such as Vanguard or iShares usually won't list a .u in Canada because they already have US-denominated ETFs trading on their US exchange. For example, VOO or IVV, which is Vanguard or iShares. These trade on the New York Stock Exchange, where BMO's .us will trade on the TSX.
Perfect. And we talked a bit about the tax considerations around that and investing in a Canadian domiciled USD ETF as well. So always consider that when looking for that exposure as well. Okay, thanks guys. I want to bring in Ravneet. Thanks for your patience. I'm really happy to have a partner from InvestorLine here to walk us through sort of the latest offer and promos on the IVL side. So I'll turn it over to you, Ravneet.
Sure, wonderful. Thank you for having me. Great commentary so far. I just want to introduce myself. My name is Ravneet Waryah. I go by Rav. I'm the regional sales manager of InvestorLine. I cover Eastern Ontario and the Atlantic region. Now today we have two limited time promotions for our self-directed and our advice-directed platforms. Viewers and participants can get additional information by going to bmo.com and select online investing, or please feel free to send me an email. On the left side here, we have our self-directed promotion. Clients can enroll by using the promo code INVESTSMART when you go online to open an account. That will provide you $4.95 per trade for the first 90 days of the account opening, which will commence on the 5th business day of the next month. So that promotion code is INVESTSMART when you open a self-directed account. On the right-hand side here, we have our Advice Direct promotion where you can receive up to $2,500 if you open and fund a new account using the promo code DIGITAL08. Fund your account with at least $10,000 in new assets. Please note those days and the dates there of when the account should be open and when it should be funded. And then on the next slide. We have over 80 commission-free ETFs to trade on with BMO InvestorLine. The full list can be found on our BMO InvestorLine website. Commission-free ETFs allow you to rebalance your portfolio, manage your risk, allow you to make tactical adjustments, and regular contributions to take advantage of dollar cost averaging. Including our BMO ETFs, our commission-free ETF providers are Vanguard and iShare. We have an ETF for every investor. We provide 5 asset classes such as equities, fixed income, multi-asset class, thematical, and ESG ETFs at no commission cost. A full list of our commission-free ETFs can be found at our BMO InvestorLine website. Please don't hesitate to send me an email at ravneet.waryah@bmo.com. I'd be happy to discuss more about our platforms and our features. Just a reminder for our participants today, use our InvestSmart promo code for self-directed accounts and Digital08 for our Advice Direct accounts.
Perfect. Thanks so much for joining us, Rav, and for giving that update and promo links for us. I'm now going to turn to a couple audience questions. We've got 2 today, so I'll send this one your way, Om. What's the outlook on tech stocks? Do your analysts see them rebounding in the next year?
Perfect. Thanks, Erin. That's a good question. Yeah, it's been definitely a tough year for technology companies. You know, I think the Nasdaq's down approximately, 30% year to date. But looking ahead, we are cautiously optimistic in the technology sector, given in the last earnings, these companies signaled a huge push for expense management. So we saw a lot of these tech companies, hiring freezes or doing restructuring to bring expenses down. Furthermore, the revenue and earnings, in these companies are expected to rise or grow, because these companies have the ability to pass that, cost, that inflation cost, along to their customers. So give you an example, if you look at Visa or MasterCard, imagine you're buying, grocery or TV, last year. Let's say a TV cost last year $1,000. You pay with your Visa or MasterCard, you're paying a percentage, or the merchant is paying a percentage to Visa. But that same TV now costs, because of inflation, let's say $1,500. And you purchase it using Visa or MasterCard, the merchant is still paying a percentage of that higher base. So for these companies, it's much easier for them to pass along that cost, to not have that impact on their overall earnings or revenue. Furthermore, right now inflation is high, but as inflation starts to slow, we find it as an interesting setup to start reinvesting in the technology sector. And there are two main reasons for this. One is it allows investors to gain exposure to secular growth that we haven't seen yet in this year. And second is potentially a reacceleration of earnings and revenue within these companies. Second, I just want to highlight, the headwinds that kind of bog these companies down year to date, they haven't dissipated yet. There's still a lot of, geopolitical tension, inflation, China zero COVID policies. So there's still a lot of headwind that we need to be careful of. So that's why taking a more cautious approach in investing in, technology is prudent. For example, one of the solutions for investors can be investing in quality technology ETFs such as ZWT, which is our BMO covered call technology ETF. And this provides, two things. You get the upside market participation, you get income, but at the same time you have lower risk versus, the broad market. So overall, we are optimistic on the technology side. However, in the short term, we can still see the volatility. But medium to long term, these are great investments as of now, given where the valuations are for these companies.
Thanks, Om. I like your idea about ZWT with the quality tech companies and that covered call overlay to provide a bit of a cushion. Okay, Andrew, the last question here. If there is a recession on the horizon, like some pundits have suggested, are there ETFs that can provide me with regular income despite the drop in global markets?
Most definitely. The yield on dividend paying ETFs specifically are becoming very attractive right now, such as ZEB, BMO's equal weight banks ETF, that's around 4.5%. ZBB, BMO's Canadian dividend ETF at 4.5% approximately. However, what's even more attractive is the covered call versions of these ETFs. ZWB, the covered call Canadian banks ETF, is paying about 7.3%, and ZWC, which is BMO's Canadian high dividend covered call, is paying around 7.5% as well. There's even covered call ETFs that are paying upwards of 8%. So for those looking to get paid while you wait out the volatility in the market and want to stay invested, these ETFs are hard to ignore. They're even drip eligible for those who are wanting to minimize a little bit of the volatility by reinvesting them. BMO is one of the largest ETF covered call providers in Canada, so there's a lot of covered call ETFs to choose from. As Om mentioned, ZWT, for instance, the tech version. So I'd recommend visiting our website at bmoetfs.com, scrolling down the product list and looking at the specialty income section. There's also a few podcasts that we've done on ETF Market Insights. I don't want to get too much into detail as how the framework of the covered calls do work, but there's also a gentleman by the name of Adrian from Passive Income Investing that talks about the BMO's covered call ETFs extensively on his podcast as well, for those who are interested to know more.
That's great. Yeah, Adrian's on YouTube, Passive Income Investor. So definitely he's done a lot around covered calls there. All right, thank you guys. That caps off another great week of ETF Market Insights. Thanks to everyone who tuned in this week. Thanks to Om and Andrew for your great insights around currency, and Rav for giving us the latest from InvestorLine. For the next 2 weeks, as I mentioned earlier, we have our Fall into ETFs special, which is a two-part, 2-week event where I will be turning over my hosting duties to some very well-known influencers and media personalities that you might recognize. We'll cover a range of topics with a number of different industry experts. So check out the trailer on our ETF Market Insights YouTube channel for sort of a sneak peek in terms of what we'll cover. But I hope you'll join us then, and bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.